Hey everyone, welcome back to day 8 of our 50-day finance explainer series. If you've just started earning or you're simply ready to take serious control of your financial future, you're exactly where you need to be. We are cutting straight through all that dense Wall Street jargon to build a stripped, no-bluff, long-term investing mindset for your hard-earned money. Today, we're moving past the absolute basics and getting our hands dirty with fundamental analysis. Think of it like learning to look under the hood of a car before you buy it. You wouldn't buy a car just because it has a shiny paint job, right? You want to know the engine is actually sound. Well, that is exactly what fundamental analysis does for stocks. Okay, so here's our ultimate 4-step X-ray vision tool for today. 1. Valuation, where we look at price and profit. 2. Health, checking out debt and returns. 3. The reality check, proving why cash is king. And finally, 4. Ownership, looking at exactly who holds the shares. Let's get right into it.
Starting off with bucket number 1, valuation, price, and profit.
Look, when checking those surface-level vitals to see if a stock's price actually makes sense, the absolute foundation is incredibly simple, yet it's so often overlooked by eager investors looking for a quick win. You've got to ensure the company's profit and sales have been consistently growing over a 3 to 5 year timeline. Why half a decade? Because, frankly, anyone can have one lucky year, right? A competitor folds or some random trend spikes their sales. But consistent, steady growth over 3 to 5 years, that proves they have a sustainable product, a working business model, and management that can actually navigate the real world.
Now, a company might boast about making millions in total profit, but as an investor, you really need to bring that massive number down to a relatable scale. To break this down to a per-share level, we use EPS, or earnings per share. Think of the company's total profit as a giant pizza. EPS tells you exactly how much pepperoni is attached to the single specific slice or share that you own. If a company makes $10 million but has 10 million shares out there, your EPS is exactly $1. And obviously, you want to see that EPS number growing year after year.
Building right on top of EPS, we get to the famous PE, or price-to-earnings ratio. This is literally the price tag you're paying today for every single dollar the company earns. If the stock is $20 and the EPS is $1, your PE ratio is 20. You're paying $20 for $1 of current earnings. Simple enough, right? But here's the catch. Looking at this number completely in a vacuum is basically useless. A PE of 20 could be a total steal, or it could be wildly overpriced.
And that perfectly illustrates our peer review rule. You absolutely must compare a PE ratio against its direct industry competitors. You just can't compare a hyped-up, high-growth software company to a 100-year-old steel mill. Their business models are completely different. But if you look at companies A, B, and C, which are all in the exact same sector, and company A has a PE of 15, while the others are sitting at 25 and 30, well, company A might just be undervalued. In this peer-to-peer matchup, a lower relative number generally means a much better deal for you.
Moving along to section 2, health, where we analyze debt and returns.
So we know the price tag, but is the underlying machine actually healthy? First up for assessing health is ROE, return on equity. Think of this as the ultimate scorecard for the CEO and their management team. It measures exactly how well they are using your invested money to generate even more profit. Give them $100 and they generate 15 in profit? That's a solid 15% ROE. As an investor, you want this number as high as sustainably possible because it proves management actually knows how to compound your wealth.
But wait, ROE has a pretty massive blind spot. It only looks at equity. Enter ROC, or return on capital employed. This goes a step further by factoring in debt to show the overall efficiency of every single dollar pumped into the business, no matter where it came from. See, a company could boast a stellar ROE just because they borrowed a mountain of cash to fund operations. ROCE strips away that illusion by looking at the total capital structure. Just like ROE, higher is generally better here, and it gives you a much clearer picture of true operational efficiency.
The real secret sauce is balancing these metrics using simple rules of thumb. You are looking for that sweet spot. You want the high returns of a strong ROE and ROCE showing the engine is powerful, but you absolutely must pair that with a lower debt-to-equity ratio. A low debt-to-equity ratio ensures the company isn't dangerously reliant on borrowing to achieve those high returns. High returns driven by massive debt? That is literally a house of cards just waiting for an economic downturn to knock it over.
All right, section 3, the reality check and why cash is king. Here is the cold, hard truth, folks. Paper profits can be easily manipulated through completely legal accounting tricks, but hard cash in the bank cannot. As a financial detective, the single most important question you can ask when staring at a shiny earnings report is the profit they're claiming actually showing up in the bank account?
A company can record a massive sale today, boosting their on-paper profit even if the customer isn't scheduled to pay for another 6 months. If that customer defaults, well, that profit was nothing but an illusion.
This is where we bring in your ultimate lie detector, comparing operating cash flow, or CFO, against profit after tax, or PAT. Profit after tax is the nice accounting story they want to tell you. Operating cash flow, that's the physical reality. By putting these two side by side, you make sure the cash reality actually matches the story. If a company claims $100 million in profit, but their operating cash flow is repeatedly negative, red sirens should be blaring. They're booking the sales, but they aren't collecting the actual cash.
Taking that cash flow one step deeper, we hit the holy grail. FCFF, free cash flow to firm. Always look for a high free cash flow. This is the pure, unadulterated cash remaining after the business is paid for necessary upgrades like fixing factory roofs or buying new software, which we call CapEx, and after paying off its debt. This is the actual money left over that can be used to pay you dividends, buy back stock, or acquire other companies. So higher is absolutely better here.
Another fantastic way to track this cash reality is through cash cycle days. This literally tracks the timeline, in days, of your money going out for inventory and coming back as sales revenue. Step 1, the company uses cash to buy raw materials. Step 2, those goods just sit in a warehouse waiting to be sold. Step 3, the customer finally pays and the cash comes back. The cash cycle measures exactly how long your money is trapped in that loop. And obviously, a faster cycle means your cash isn't just gathering dust in some warehouse. So remember this golden rule. A lower number of cash cycle days signifies a highly efficient business. If Company X takes 30 days to turn inventory back into cash, and Company Y takes 120 days, Company X has a massive competitive advantage. They can reinvest their cash 4 times faster.
Finally, Section 4, Ownership. Let's see who actually holds the shares. We need to check out the genetic history of the company. Who actually owns this business, and are the insiders buying or bailing? Here is your simple shareholding cheat sheet. You always want to follow the smart money. Increasing backing from foreign institutional investors, FIIs, and domestic institutional investors, DIIs, is a massive green flag. It means professional analysts have vetted the company and are pouring millions into it. But pay really close attention to this. If the original founders or promoters are significantly decreasing their holdings, that is a glaring negative warning sign. I mean, if the people running the show are quietly rushing for the exit, why on earth would you want to walk through the front door?
As we wrap up Day 8, I really want you to burn this quote into your memory. Profit is an opinion. Cash is a fact. Whenever you are doing fundamental analysis for long-term investing, you have got to heavily emphasize operating cash flow and free cash flow. It cuts right through all that Wall Street noise, the creative accounting, and the management spin. Cash just cannot be faked.
So, armed with this complete no-bluff toolkit, valuation, health, the cash reality check, and ownership, which of these 4 X-ray tools are you going to use first to verify if a company is truly worth your long-term investment? The next time you look at a stock, don't just stare at the price tag. Hunt down the cash, check the debt, and see who is actually holding the shares. Keep building that rock-solid financial mindset, and I will see you in the next explainer.